Hello and welcome to Week 3, Itemized Deductions. By the end of this lesson, students should be able to describe the use of the standard deduction and itemized deductions, and identify tax reduction techniques. So this lesson will be focusing on itemized deductions, but it's important to remember that in the tax formula that we've been looking at for the past 3 weeks, we need to remember that the standard deduction may be used if it is greater than itemized deductions. So let's talk about the standard deduction first. It's a statutory amount. It's indexed for inflation each year, so refer back to your textbook for the latest numbers. And it also depends on your filing status. So single, married filing jointly, married filing separately, head of household. All of these filing statuses have their own separate standard deduction. So when we're determining whether we itemize or we take the standard deduction, the first step is to identify what is our standard deduction for the year. Once we've done that, then we take a look at our itemized deductions. And just as a refresher, we've been talking about this for several lessons now. The most common itemized deductions include medical expenses, state and local taxes, real and personal property taxes, mortgage interest, charitable contributions, and certain casualty losses, not all. So let's take a look at these in more detail. First, let's look at medical expenses. So to get $1 of deduction, your unreimbursed medical expenses need to be more than 7.5% of AGI. That means, first of all, unreimbursed means that it's not reimbursed through an HSA plan, it's not reimbursed through a flexible spending account, and it's not reimbursed through insurance. So this is your true net out-of-pocket post-tax costs. Those costs need to be more than 7.5% of AGI before you get $1 of deduction. The expenses that we're including, once we've met those hurdles, would be medical insurance. Now remember, if you're self-employed, medical insurance actually goes on page 1. It does not go on Schedule A. And if you're an employee, most employers are going to take those premiums pre-tax, which is actually a better deal, right? If it's pre-tax right off the top of your wages, you get a dollar for dollar in effect reduction in your income. But if it is post-tax and you're deducting it on Schedule A, most people, unless they have a very catastrophic illness, are not going to meet that 7.5% of AGI limit in a given year. And so in effect, those medical insurance premiums aren't deductible. An exception would be for maybe taxpayers who are retired. They are on Medicare, and Medicare premiums are deductible. They're not pre-tax. And then they probably have some sort of Medicare supplement. So in those instances, you may see premiums rising to the level, particularly if they don't have a lot of taxable income in retirement, where that might make a difference. But just remember, regardless of the taxpayer situation, these need to be post-tax expenses. In addition to pure medical insurance, long-term care insurance is also considered a type of medical insurance and eligible for the deduction, but long-term care insurance premiums are limited to a standard amount based on your age. So again, refer back to the textbook for those different numbers. And if you are advising clients about long-term care insurance, just know that at best, we can say the premiums are partially deductible. Typically, they are not totally deductible. Medical expenses also include prescription drugs, but not over-the-counter drugs. And also, it needs to be a medically necessary procedure, so it can't be a cosmetic procedure. Next, let's talk about state and local taxes. So there are a few types of state and local taxes that are deductible for itemized deduction purposes. The first is either the higher of your state and local income taxes, and for taxpayers who live in states where there is no state income tax, no local income taxes, then they can deduct sales tax. Now, it is possible for a taxpayer to actually manually keep track of every time they buy something, the amount of sales tax charged, or maybe keep track of all purchases of products during the year and apply some formula knowing your local sales tax rate. But Most people don't do that. And fortunately for most of us, the IRS does publish tables. So, based on a taxpayer's total income and the county in which they reside, so the county listed on their tax return, you can come up with a table amount and you can compare those two, and you deduct the higher of either your income taxes or your sales tax. So obviously if you live in a state like Texas, Tennessee, Nevada, there's no state income tax. You're probably going to end up with a sales tax deduction unless you have some activities in another state and are paying state income taxes somewhere else. If you live in a higher tax state, the East Coast and the West Coast actually have pretty high income taxes, then you'll probably take that state and local income tax deduction. But that's a determination that's made each year. So if you deduct sales tax one year, you're not locked into that for a period of time. It's an evaluation on a year-to-year basis. In addition to income tax or sales tax, those who own property, own real estate, can deduct real estate taxes, and there's no limit to the number of properties upon which you can deduct real estate taxes. You just have to be the one that's actually writing the check, so the money is coming out of your bank account. In addition to real estate taxes, many states assess personal property taxes. The most common types of personal property taxes are on automobiles, but they could also be on boats, ATVs, trailers, RVs. Any personal property tax is deductible as well. And relatively recently, there is a new limit. So we have a section on Schedule A, basically called the tax section. It's made up of these three types of taxes. And the total of these three taxes together can only total $10,000 or less. So in other words, you could actually pay more than $10,000 in income taxes, but your deduction is limited to $10,000, which means if, for instance, you own several properties or you live in an area with very high property values and real estate taxes, perhaps your real estate taxes are $11,000. You've also got some state and local taxes and personal property taxes. Those really don't matter because you're capped out at $10,000. So that's something to keep in mind when you're planning for itemized deductions for your clients. Next, we'll talk about interest. There are several types of interest that are deductible. Interest for business, interest generated to generate investment income, and mortgages are deductible, but consumer interest is not deductible. So let's talk a little bit more about what those items mean. A taxpayer can deduct interest on mortgages for up to 2 residences. And so here we say 2 personal residences. Technically speaking, that's your primary residence and another home. It could be a vacation home. It could be a home that you own that a child or a parent is living in, but you are able to deduct interest on 2 mortgages.